For most of modern economic history, debt played a supporting role rather than a leading one. Governments, households, and businesses used borrowing to smooth temporary shocks, finance long-term investments, and bridge gaps between income and expenditure. Debt was a mechanism, not the engine, of growth. In the decades following World War II, this distinction was clear. Public debt levels were high in many countries due to wartime spending, but growth strategies focused on productivity, industrial expansion, and rising incomes. Between 1950 and 1973, advanced economies experienced strong real growth driven by manufacturing, infrastructure, and labor force expansion. As incomes rose, debt burdens became easier to manage, not heavier. Growth reduced debt ratios rather than the other way around. Household debt during this period remained modest. In the United States, household debt hovered around 40 and 45% of GDP through much of the post-war era. Mortgages existed, but credit standards were conservative and borrowing was closely tied to income growth. Corporate debt followed a similar pattern. Firms borrowed primarily to expand productive capacity, factories, equipment, logistics, rather than to support valuations or financial engineering. Crucially, debt was anchored to expected future income. The assumption was simple. Growth would come from higher output, and debt would be serviced from that growth. Borrowing was justified by productivity gains, not by rising asset prices. When debt increased, it was usually accompanied by tangible expansion. This framework began to shift in the 1970s. As productivity growth slowed and inflation disrupted traditional policy tools, governments faced rising fiscal pressures, while households experienced weaker wage growth. The question quietly changed from how do we generate growth to how do we maintain stability. Debt began to play a larger role in answering that question. At first, this shift looked temporary. Borrowing helped smooth adjustment during periods of transition. But over time, debt moved from being a response to slow growth to becoming a substitute for it. Instead of growth supporting debt, debt began supporting growth. This reversal would define the next several decades of economic policy and behavior, and it would reshape how economies functioned at every level. If you value long-form historical economic analysis that explains how systems change over time, consider subscribing and sharing your thoughts in the comments. Because once debt stopped supporting growth and started replacing it, the next question became unavoidable. How did borrowing turn into a permanent growth strategy? As productivity growth slowed after the 1970s, economies faced a structural gap that was difficult to confront directly. Wages no longer rose as reliably. Industrial expansion matured. Demographic tailwinds weakened. Yet expectations of rising living standards, stable employment, and political legitimacy remained anchored to the post-war experience. Borrowing emerged as the most convenient way to bridge that gap. During the 1980s and 1990s, debt expansion became a quiet substitute for missing growth. Governments used fiscal deficits to sustain demand during downturns. Households relied more on credit to maintain consumption as wage growth lagged. Corporations increased leverage to support expansion, mergers, and shareholder returns. Each sector responded rationally to the same pressure. Growth was harder to generate organically, so borrowing filled the space. This shift was reinforced by structural changes in finance. Deregulation expanded credit availability. Global capital flows increased the supply of lendable funds. Interest rates trended downward over time, reducing the apparent cost of borrowing. In the United States, the federal funds rate averaged over 10% in the early 1980s, but fell steadily over the following decades. Lower rates made higher debt loads appear manageable, even sustainable. Household debt illustrates this transition clearly. As real wages stagnated for many workers after the 1980s, credit increasingly supported living standards. Mortgage markets expanded. Consumer credit became more accessible. By the early 2000s, household debt in the U.S. had risen to over 70% of GDP, nearly double its post-war level. Similar patterns appeared in the UK, Canada, and parts of Europe. Consumption continued, GDP grew, and the pressure to restore wage-led growth diminished. Government borrowing followed a parallel path. Fiscal deficits became more common, not only during recessions, but during expansions as well. Debt was no longer viewed as a temporary response to shocks, but as a persistent feature of economic management. As long as borrowing sustained demand and avoided instability, it was tolerated, even encouraged. What made this strategy appealing was that it worked, at least initially. Borrowing supported growth without requiring difficult structural reforms. It postponed trade-offs. It maintained social expectations. Debt didn't feel like a problem because it delivered stability. But this approach came with an important assumption, that future growth, lower interest rates, or rising asset values would make today's debt manageable. This assumption quietly replaced the older belief that productivity and income would do that work. Debt stopped being a bridge and became the road itself. If this framing resonates, consider subscribing and sharing your thoughts below. Because once borrowing fills the gap left by slower growth, the next issue becomes unavoidable. What happens when debt expands faster than the economy supporting it? Once borrowing became a routine substitute for slower growth, a critical threshold was crossed. Debt began to grow faster than the economy itself. This is the moment when debt stops being neutral and starts reshaping incentives, risks, and long-term outcomes. The change was gradual, which is why it went largely unnoticed at the time. By the late 1990s and early 2000s, this pattern was clearly visible across advanced economies. Total debt, combining government, household, and corporate borrowing, rose steadily relative to GDP. In the United States, total non-financial sector debt increased from roughly 140% of GDP in 1980 to over 220% by 2007. Similar trajectories appeared in Japan, the UK, and much of Europe. Growth continued, but leverage increased faster. What made this dynamic appear sustainable was the environment in which it occurred. Interest rates were falling, inflation was subdued, asset prices, especially housing and equities, were rising. These conditions reduced the apparent burden of debt. Servicing costs remained manageable even as principal amounts grew. Balance sheets looked stable as long as valuations held. But the shift mattered because it reversed the logic of growth. Instead of output expansion supporting borrowing, borrowing began supporting output. Economic activity became increasingly sensitive to credit conditions. When credit expanded, growth followed. When credit slowed, growth weakened. Debt stopped being a background variable and became a driver. This altered behavior at every level. Households adjusted expectations around borrowing. Governments became more comfortable running deficits. Corporations leveraged balance sheets for financial strategies rather than productive investment. Each actor responded rationally to incentives, but collectively the system became more fragile. The problem with debt growing faster than the economy is not immediate insolvency, it's path dependence. Once growth relies on rising leverage, reducing debt becomes difficult without slowing activity. Attempts to deleverage often trigger recessions, which reinforce the perceived need for continued borrowing. The system learns to avoid adjustment. This dynamic set the stage for the next phase, where debt expansion became closely tied to asset prices and financial stability, and where the risks of the strategy would eventually surface. If you find this explanation useful, consider subscribing and joining the discussion. Because once debt grows faster than the economy, the next question becomes unavoidable: how asset prices were used to sustain the entire structure. Once debt began growing faster than the underlying economy, the system required a stabilizing force to prevent strain from turning into crisis. That force became asset prices. Rising valuations didn't just create wealth effects, they became the mechanism that kept expanding debt sustainable. This is where debt and asset inflation fused into a single growth strategy. The logic was simple, but powerful. Higher asset prices improved balance sheets. Stronger balance sheets justified more borrowing. More borrowing supported spending and investment, which in turn helped sustain growth. As long as asset values continued to rise, debt burdens appeared manageable. This dynamic was especially visible in housing markets, where collateral values played a central role in credit creation. By the early 2000s, this feedback loop was firmly in place. In the United States, real home prices rose sharply between 1997 and 2006, while household mortgage debt expanded in parallel. Rising equity markets reinforced the same pattern on the corporate side, supporting leverage, mergers, and financial engineering. Governments benefited as well. Higher asset values boosted tax revenues and reduced visible fiscal stress. What made this arrangement appealing was its apparent stability. Asset inflation reduced the urgency to confront slower productivity growth or stagnant wages. As long as prices rose, debt service remained manageable, defaults stayed low, and growth continued. The economy appeared resilient, even as its foundations weakened. The danger, however, lay in the assumption that asset prices would continue rising indefinitely. When growth depends on valuation rather than income, the system becomes sensitive to shifts in confidence, interest rates, and credit availability. Small disruptions can have outsized effects because debt is calibrated to elevated prices. The 2008 financial crisis exposed this vulnerability. When housing prices stopped rising and then fell, collateral values collapsed, leverage reversed, and the entire debt structure came under stress. What had looked like sustainable growth quickly revealed itself as fragility masked by asset inflation. Yet the crisis did not end the strategy. It refined it. Post-crisis policies focused on stabilizing asset prices even more aggressively. Interest rates were lowered to historic levels. Liquidity was injected into financial markets. Asset values recovered and debt expansion resumed. The lesson absorbed by the system was not to reduce dependence on asset prices, but to manage it more carefully. If this analysis helps clarify why asset inflation became inseparable from debt-led growth, consider subscribing and sharing your thoughts below. Because once asset prices became the glue holding the debt system together, the next issue emerged quietly: Risk was no longer where people thought it was. Once asset prices became the glue holding the debt system together, risk didn't disappear. It moved. Instead of being visible in defaults, bankruptcies, or inflation, risk migrated into balance sheets, expectations, and institutions. This shift made the system appear safer even as it became more fragile. Before debt became a growth strategy, risk was easier to identify. Borrowers who took on too much debt failed. Lenders who mispriced risk absorbed losses. Cycles were shorter and more painful, but they forced adjustment. As asset prices took on a stabilizing role, this clarity faded. Rising valuations masked leverage. As long as prices held, risks appeared contained. Financial institutions adapted quickly. Risk models increasingly assumed stable or rising asset values. Stress scenarios became narrower. Capital flowed toward activities backed by collateral rather than cash flow. Housing finance, government bonds, and large financial intermediaries absorbed growing shares of credit because they were perceived as safe. Meanwhile, productive but uncertain investments struggled to attract funding. Governments reinforced this dynamic, often unintentionally. When crises threatened asset markets, interventions limited losses. Bailouts, liquidity facilities, and monetary easing reduced downside risk for systemically important sectors. This protected stability, but it also taught markets that extreme outcomes would be managed. Risk-taking increased not because fundamentals improved, but because consequences felt remote. Households adjusted expectations as well. Borrowing against depreciating assets felt prudent rather than speculative. Long-term debt commitments became normal. Risk shifted from visible defaults to future vulnerability, exposure to interest rates, employment shocks, and price reversals. These risks were harder to see and easier to ignore. What made this transformation dangerous was its cumulative nature. Each cycle that ended without major losses reinforced confidence in the system. Risk didn't vanish, it concentrated. When stress eventually emerged, it threatened the entire structure rather than isolated segments. This is how debt-led growth creates the illusion of safety. The system becomes resilient to small shocks, but increasingly exposed to large ones. Stability improves at the surface level, while fragility builds underneath. If this perspective adds clarity, consider subscribing and sharing your thoughts in the comments. Because once risk moves out of sight, the next question becomes unavoidable. Who ultimately carries it when the system is stressed? Once risk moves out of sight, it doesn't disappear, it is redistributed. And over time, the burden shifts away from individual decision makers and toward the broader public. This is the stage where debt stops being a private choice and becomes a system-wide responsibility. In debt-led growth systems, households, firms, and governments all take on leverage under the assumption that stability will be maintained. But when stress appears, not all actors bear the consequences equally. Smaller borrowers fail first. Larger institutions are protected. Governments intervene to prevent systemic collapse. The result is a gradual transfer of risk from private balance sheets to public ones. The 2008 financial crisis made this dynamic explicit. When housing prices collapsed and leverage unraveled, governments stepped in to stabilize banks, guarantee liabilities, and restore confidence. Losses that originated in private credit markets were absorbed through public support, central bank balance sheets, and long-term fiscal commitments. The immediate crisis was contained, but the structure of risk shifted. After 2008, this pattern became normalized. Central banks expanded their role as lenders of last resort and market stabilizers. Government debt rose sharply, not just to fund stimulus, but to backstop financial systems. By the 2010s, public balance sheets in many advanced economies had absorbed risks that previously sat in private markets. Stability was preserved, but the cost was socialized. This shift altered incentives. If severe downside risk is ultimately shared, behavior adjusts. Private actors continue to borrow and invest, confident that extreme outcomes will be managed. Governments accept higher debt loads to maintain stability. The system becomes dependent on continuous intervention, even if that dependence is rarely acknowledged. Importantly, this does not mean policymakers act irresponsibly. In many cases, intervention is the least damaging option available. Allowing widespread collapse would impose immediate and severe costs, but repeated intervention changes expectations. Risk is no longer priced the same way. Debt accumulation feels safer than it truly is. The long-term consequence is a system where stability is maintained through public exposure. Governments carry larger balance sheets. Central banks manage more assets. Fiscal and monetary policy become intertwined. The economy functions, but flexibility narrows. Each new shock adds to the burden. If this explanation helps clarify who ultimately absorbs risk in debt-led systems, consider subscribing and sharing your perspective. Because once the public sector becomes the backstop for private debt, the next issue becomes unavoidable. How this changes policy choices and long-term growth itself. Once the public sector becomes the backstop for private debt, economic policy is forced to adapt around that reality. At this stage, policy priorities quietly shift, not because governments abandon growth, but because maintaining stability becomes a precondition for everything else. Debt-led growth changes what policymakers can realistically pursue, and what they are willing to risk. The most immediate change appears in monetary policy. Interest rates, once used to manage inflation and smooth cycles, become constrained by debt sensitivity. Higher rates raise servicing costs for households, firms, and governments simultaneously. Even modest tightening can ripple through housing markets, equity valuations, and public finances. Policymakers learn that normalization is risky, and so rates remain lower for longer. Stability takes precedence over correction. Fiscal policy adjusts as well. Governments may want to invest in productivity-enhancing areas such as infrastructure, education, or housing supply, but these policies require time and political capital. In contrast, debt-financed support delivers immediate relief. Deficits become easier to justify than reform. Over time, borrowing is normalized as a policy response. Even outside crises, debt-led systems also narrow the range of acceptable outcomes. Policymakers become more focused on preventing downside scenarios than enabling upside potential. Growth strategies are filtered through the question, will this destabilize balance sheets? If the answer is unclear, caution wins. This reinforces a preference for incrementalism over transformation. Political incentives reinforce the shift. Large segments of the population are exposed to debt and asset prices through mortgages, pensions, and savings. Policy that threatens valuations risks backlash. Stability becomes not just an economic objective, but a political necessity. Governments manage expectations rather than resetting incentives. Over time, this produces a subtle inversion. Policy no longer asks how to generate growth sustainably. It asks how to prevent instability while growth remains weak. Debt, which began as a tool to smooth adjustment, becomes the condition around which policy revolves. If this framing helps explain why economic policy feels cautious and reactive, consider subscribing and sharing your thoughts in the comments. Because once policy priorities adapt to debt-led growth, the next question becomes unavoidable. What does this do to productivity, innovation, and long-term potential? Once policy priorities adapt around sustaining debt, productivity is often the first long-term casualty. This doesn't happen because economies stop innovating or because workers become less capable. It happens because the conditions that support productivity growth become harder to maintain in debt-led systems. Productivity growth depends on investment, experimentation, and time. Firms need to invest in new technologies, processes, and skills before gains appear. Workers need flexibility to move, retrain, and take risks. Governments need space to tolerate short-term disruption in exchange for long-term improvement. Debt-led growth constrains all three. High debt levels raise the cost of failure. For households, large mortgage and consumer debt obligations reduce risk tolerance. Job mobility declines. Entrepreneurship becomes less attractive. People prioritize income stability over opportunity. For firms, leverage increases pressure to deliver short-term returns. Capital is allocated toward activities with predictable cash flows rather than uncertain productivity gains. Long-term projects are postponed or abandoned. Policy reinforces this bias. When stability is paramount, governments and central banks favor measures that protect existing structures. Support flows toward large, systemically important firms and sectors. Smaller, innovative, or disruptive entrants face higher barriers. Competition weakens. Productivity growth slows, not because innovation disappears, but because it diffuses less effectively across the economy. This pattern became especially visible after 2008. Despite rapid advances in digital technology, productivity growth across advanced economies remained historically weak throughout the 2010s. In the United States, labor productivity growth averaged just over 1% per year, well below post-war norms. Europe and Japan experienced similar outcomes. Technology advanced, but its economic impact was diluted by structural constraints. Debt also distorts investment incentives. When asset prices rise faster than productive returns, capital gravitates toward valuation rather than output. Financial engineering outperforms real investment. Share buybacks, mergers, and asset accumulation become more attractive than building new capacity. Over time, the economy becomes efficient at managing balance sheets, but inefficient at expanding productive potential. The result is a paradox. Economies appear sophisticated, capital-rich, and technologically advanced, yet struggle to translate these advantages into broad-based growth. Productivity doesn't collapse. It underperforms. Each year's slowdown feels small. Over decades, the loss compounds. If this explanation helps clarify why productivity growth remains elusive despite innovation, consider subscribing and sharing your perspective below. Because once productivity weakens in a debt-led system, the next question becomes unavoidable. How long can growth be sustained before the model begins to exhaust itself? Once productivity weakens inside a debt-led system, the model doesn't fail immediately. Instead, it enters a phase of diminishing returns, where each additional unit of borrowing delivers less growth than before. This is the point at which debt-led growth begins to exhaust itself, not through collapse, but through fatigue. Early on, debt expansion is powerful. Borrowing boosts demand, supports investment, and smooths shocks. But as debt accumulates, its effectiveness declines. More income is diverted towards servicing existing obligations. Balance sheets become less flexible. New borrowing increasingly goes toward refinancing old debt rather than funding new activity. Growth continues, but it becomes harder to generate. This dynamic has been observed repeatedly in economic history. Studies of advanced economies show that when total debt exceeds certain thresholds relative to GDP, the marginal contribution of new borrowing falls sharply. By the 2010s, many advanced economies were adding significant debt for modest growth gains. Debt didn't stop working, it just worked less well. At this stage, policy interventions must become larger and more frequent to achieve the same effect. Interest rates fall further, fiscal deficits expand, central bank balance sheets grow. Each intervention stabilizes the system but also deepens dependence. The economy becomes more sensitive to withdrawal of support, even as the benefits of support diminish. Households feel this exhaustion directly. Rising debt no longer delivers rising living standards. Consumption growth slows. Security replaces optimism. Firms experience it as well. Expansion becomes cautious. Returns on investment disappoint. Governments experience it as fiscal strain. Higher debt with limited improvement in growth capacity. What makes this phase difficult to recognize is that nothing obviously breaks. Employment may remain stable. Asset prices may continue rising. GDP may grow modestly. But momentum fades. The economy feels heavier, less responsive. Each recovery feels weaker than the last. This is how debt-led growth models persist long after their peak effectiveness. The system adapts to lower expectations. Stability is maintained, but progress slows. Adjustment is postponed because alternatives feel riskier than continuation. If this analysis resonates, consider subscribing and sharing your thoughts in the comments. Because once debt-led growth begins to exhaust itself, the final question comes into focus: what happens when stability can no longer substitute for real growth? Once debt-led growth begins to exhaust itself, the system reaches its most fragile phase, not because collapse is imminent, but because stability stops delivering legitimacy. This is the point where maintaining order, confidence, and asset values is no longer enough to offset weak progress in living standards. Growth hasn't vanished, but it no longer feels meaningful. At this stage, economies face a credibility problem. For decades, stability-first policies worked because they prevented visible crises and preserved a sense of continuity. Asset prices rose, employment remained steady, institutions held. But as productivity stagnates and debt burdens accumulate, the benefits of stability become increasingly uneven. For large parts of the population, stability looks like stagnation. This is where social and economic expectations begin to diverge. Governments point to GDP growth, low unemployment, and resilient markets. Households point to rising costs, limited mobility, and shrinking margins for error. The metrics that once justified debt-led strategies lose their persuasive power. Stability is no longer perceived as success. It becomes the baseline. Policy options narrow further. Expanding debt delivers diminishing returns. Cutting support risks destabilization. Structural reform remains politically difficult. The system becomes trapped between continuation and correction, with neither path offering a clear resolution. This is not a crisis moment, it is a confidence erosion moment. Historically, this phase often precedes major adjustment, but the form of that adjustment is unpredictable. It may arrive through slow stagnation, inflationary pressure, demographic shifts, geopolitical change, or external shock. What is consistent is that systems built on debt and stability eventually face limits that policy alone cannot smooth over. Importantly, this does not mean collapse is inevitable. Many economies can persist in this state for extended periods, but the longer growth is deferred, the higher the eventual cost of transition. Debt accumulates, policy credibility weakens, expectations adjust downward. The economy adapts, but to a lower ceiling. Understanding this phase reframes the debate. The question is no longer whether debt-led growth can continue. It is what kind of future it produces if it does. Stability without progress can sustain systems, but it cannot inspire them. To see how governments arrived at this point, and how asset prices became central to maintaining stability in the first place, watch our previous video, How Governments Learned to Depend on Asset Prices, Stability Over Growth. Together, these videos explain why modern economies look stable on the surface, yet struggle to move forward beneath it. If you value long-form, historically grounded economic analysis that focuses on systems rather than headlines, consider subscribing, sharing your perspective in the comments, and joining us for future deep dives into how growth models evolve and eventually reach their limits.